What is non-resident state income tax filing? Have you ever wondered what happens if you earn money in a state where you do not live? This situation is where non-resident state income tax filing comes into play. Let's break this down to understand it better. Non-resident state income tax filing is the process of submitting a tax return in a state where you do not reside but have earned income. This usually happens when you receive wages, rental income, or business profits from a state different from your home state. The main idea is that you need to report income earned in a state where you are not a resident. Your state of residence is where you primarily live and pay taxes on your worldwide income. However, if you earn money in another state, that state may requiring you to file a non-resident tax return. For instance, if you live in state A but work part-time in state B, you may need to file a non-resident return in state B for the income earned there. At the same time, you would file a resident return in state A for your total income. Each state has its own rules about when you need to file a non-resident return and what income you must report. Some states have minimum income thresholds for filing, while others have agreements to prevent double taxation. For example, some states allow you to claim a tax credit on your resident return for taxes paid to the non-resident state. This helps you avoid paying tax twice on the same income. Common types of income that requiring non-resident filing include wages earned while working in the non-resident state, rental income from properties located there, and business profits from activities conducted in that state. Also, income from trusts, estates, or partnerships sourced to that state may requiring filing. Even gambling winnings or the sale of property within the state can trigger this requirement. It is important to note that income like interest from out-of-state bank accounts typically does not requiring non-resident state filing. This income is usually reported on your federal and resident state returns. From a budgeting and financial planning perspective, understanding non-resident state income tax filing is essential. It helps you avoid unexpected tax bills and penalties. If you earn income in multiple states, tracking where your income comes from is vital. This awareness allows you to plan your taxes accurately and ensures correct withholding. Additionally, some states do not impose income tax at all, such as Florida, Texas, and Washington. If you earn income in these states, you generally do not file a non-resident return there. However, you still report that income on your resident state and federal returns if applicable. In summary, non-resident state income tax filing is necessary when you earn income in a state where you do not reside. It involves filing a tax return in that state to report income earned there while also filing a resident return in your home state. Being aware of these requirements helps you manage your income taxes effectively and supports practical budgeting by preventing unexpected tax bills.